I'm going to jump right in and probably risk never being invited back to this conference and ask the question, why on earth would anybody want to do that with their money? Because I personally struggled with that thought for a while. And I'm playing the devil's advocate here, the devil not being me really, but being the traditional finance academic, the Milton Friedman that was mentioned yesterday as well. And I'd like to do another thing that's probably not very popular in a scientific conference, and just to give a bit of anecdotal evidence. I came across this field seriously about 1.5 years ago, and since then I've been running around asking every single finance professional or academic I meet whether they personally invest their money sustainably. And in fact, I wanted to run a short survey this morning with the audience in here, and it was recommended I better not do that. And the answer I usually get back is not a substantial amount, very minimal or nothing at all. And when I probe into why, the answer is usually I would rather not combine the two. I'd rather do well, invest traditionally, and I'd rather do good in a separate context. And this idea of this notion that doing well and doing good should probably not be combined is not something that I've invented, certainly, but it's occurred in the economics literature, and it's been heavily researched from various angles. Just a bunch of examples I'm listing here. In the experimental finance literature, there's evidence that preferences for sustainability are contextual, and that goes with the anecdotal evidence I mentioned earlier. And by the way, the anecdotal evidence is by now based on N close to 50 plus 1. There's amazing research in neuroeconomics, also straight out of University of Zurich, where I was based at earlier this year, that shows that there is an built-in neurological conflict in our brain between the part that has a moral motivation and the part that has the wealth motivation in it. And there's plenty of research also in behavioral economics that shows that just the fact of entering a market is going to eradicate any moral values you have. And one of my absolute favorite papers here is an experimental work coming out of Bonn, and I strongly recommend everybody to read it. It's called Morals and Markets, was published in Science. And here the experiment gave the participants the option to choose between saving the life of a mouse or gaining 10 to 20 euros. And by entering a market condition, people tended to actually want to gain that money. So the competition, the market environment tended to lead people to choose the doing well over the doing good part. And again, this is not 21st century economics only, but doing well while doing good, the inherent inconsistency that I personally struggle with came out of Karl Marx and Thorsten Veblen that famously expect markets to bring out the worst in people. They are also not big fans of the market in general and say that it's going to eradicate any good that we have in us. But then on the other hand, there's grass fee, and there's the momentum in sustainable finance. Everybody's talking about it. Practitioners are talking about it. Academics are starting to look more and more into it. I certainly want a piece of it as well. So what's going on in here? How can we find out if investors are actually buying into the doing well while doing good paradigm? Well, one thing would be to run around the entire world and ask every single investor about the proportion of their wealth invested. But another thing that we can do is to look at data, because the finance universe has awesome data available, pretty much everything. Lots of indicators, returns, volumes, etc. Anybody doing finance research is familiar with that. And so what you can see in that picture here is an attempt of mine to measure investor sentiment in the sustainable finance space. So before I explain what this picture shows, I'm not going to go deep into the methodological component, because on the one hand it's work in progress, and on the other hand I'd like to keep it proprietary for a while because I hope to publish this one day. But here, what is investor sentiment in the traditional behavioral finance sense? It's really the individual's individual investors' personal attitude or mood as to anticipated future price movement. So do investors believe the market is going to go up? Are we in a bear or a bull market? And there are various indicators one can use to measure that. And there's, again, a very famous paper published in the Journal of Finance by Baker and Burgla. It's called Investor Sentiment, which I'm basing the methodology, on which I'm basing the methodology here. So in gray, I've just measured here the market sentiment. I think this is US equities market. And you can see there are periods where the sentiment goes up, there are periods where the sentiment goes down. A classic example is the tech bubble around the turn of the century. And here you can see a lot of people were buying into it, and it's really going up, and then it kind of crashed and went down again. And so I thought, why don't we measure investor sentiment in the sustainability space, using the data available, the various indicators on various assets. And so I did this, and I was kind of hoping to see over the last 10 years a kind of tech bubble increase, just given the hype around sustainable finance. And so far what I've seen is it's just flat, and there's a bit of a negative correlation with the market sentiment. And now the question is, what's going on here? People are talking about it, maybe people are not actually investing in it. And this is where behavioral finance comes in. I borrowed this, these are making fun of the United Nations, this picture. I don't know if it came out in the New Yorker or somewhere else, but we can apply the same picture in the sustainable finance space and ask, where is this dichotomy coming from? The hype versus what likely the data is telling us that not enough people are buying into it. And this is really the purpose of my talk and the purpose of this research program that I've found myself in the last year and a half. And so what I'll do today is I'll just briefly talk about what I mean by behavioral foundations of sustainable investing. And then I kind of decided last minute to sneak something else in because the focus so far in the behavioral economics literature that is dealing with sustainable finance is about social preferences. The idea that anybody that has sustainable investing preferences is likely also to be a pro-social person. So I'm going to focus a bit on that and show you an experiment, and there's a paper coming out soon, I hope, with the title Doing Well While Feeling Good. Very important disclaimer. I will not in any way address, probably also answer any questions that deal with measurement of ESG and SRI beyond this talk, and controversial, the impact of the decision, if this is something that Paul mentioned yesterday, what is the impact of actually investing sustainably or putting our money into anything ESG? Not talking about that, I'm not addressing performance. I'm really simply addressing this paradigm, doing well while doing good, and what would be the behavioral drivers or barriers leading people to invest in or not invest in that. And I will come back to these 3 points at the end of the talk as well. So how would we go about and understand the decision-making process, the brain of a person that is faced with a decision to invest sustainably? Well, we can look at their utility. The utility in economics represents what they personally get out of it. And here's a very simple model, the only equation that will appear in today's talk. The paper elaborates on this a bit. And this utility almost literally models the doing well and doing good. There's a component, W, that's the utility of the wealth part. So somebody wants to invest, they want to make money, obviously, or generate some return. It could also be some risk-adjusted utility. It could be Markowitz. You can plot anything you want in there. And then there's the doing good part. There's the social aspect of the equation. And that's utility EI in here. And I stands for every individual. And then there's a bunch of parameters. The parameter alpha basically reflects how important this other component is to one person. So if alpha is equal 0, you're just a traditional investor and you say, I just want to generate wealth, and I don't want to have to deal with this other part. But then as soon as it goes to beyond 0, any kind of positive number you plug in there, people will get a different type of utility out of the sustainable investing. And now the interesting thing here, something again that came up yesterday, is that people are willing to sacrifice return and the irrationality of it all But if alpha is strong, big enough, it's going to offset this negativity that you get out of the wealth utility. So this is a way to explain what we're finding in the lab, in the field. This willingness to give up something in order to invest, to get the good utility out of it. And then there's two other parameters, S and beta. S is assumed to be an objective measure of sustainability, which does not exist yet. And beta is what this talk and this paper that this talk is based on is about. It's a vector of behavioral drivers. And I go on in about 50 pages about how there's so many behavioral drivers other than social preferences that have yet to be looked at. Because the focus has been really on just people want to do good, people want to change the world, people want to take the CO2 emissions down. But there may be other factors coming into play. And I'm listing, like I said, anybody that has time at all to read 50 probably incoherent papers. I'm listing just a bunch here. Time preferences, I think, are going to play a role. Do you have a long or short horizon in your investment? Myopic loss aversion is closely related. Something I'm working on with a colleague of mine is your risk perception of what these investments look like and whether or not you maybe are just averse to ambiguity and uncertainty. You want to invest in the devil that you know rather than the devil that you don't know. And lots of other things. The endowment effect may play a role because you want to hold on to what you're already invested in, and it's more difficult to get somebody to give this up for something completely new. And like I said, I wanted for the rest of this talk now to focus on social preferences, because it's pretty much now established that social preferences, somebody who's more willing to donate more in a dictator game or any of these other experimental games, or more willing to donate to charity, is more likely going to invest sustainably. And I'm quoting, of course, Paul's amazing Journal of Finance paper here. And now the economics literature has researched, and the psychological and the social science literature, and the philosophers actually have researched this notion of altruism quite extensively. And in its essence, you're an altruist when you're willing to sacrifice something in order to benefit someone else. So there's this idea of impact built into altruism. And there's kind of an agreement, up to 90% maybe, that usually something that looks like it's altruistic actually has an ulterior motive in it. Doesn't have to be a bad motive, you're still doing something good. But it's not necessarily the benefit of the others or the impact that is driving the decision. And this is what now my hypothesis is. The question is the warm glow of having done this amazing sustainable investing thing the main driver rather than the actual impact? Because like I said, the question of impact is still fairly open, in my opinion at least. And so my University of Zurich are very familiar with this experiment I ran. The colleagues that are sitting right there, shout out to them. They're familiar with the experiment I ran earlier this year at the university. I sent out an email to every single employee at the university and asked them a very simple question within the pension fund framing. So would you be willing, if your University of Zurich pension fund came to you today and asked you, I'm going to invest all of your pension fund savings. For us, this is probably the next 30 years of savings, a little less, into a sustainable investing fund. I got the answers from about 700 participants, 648 I could use. And I won't go into the methodological aspect either. And now the two hypotheses, the two questions I want to address are, is the warm glow of giving an ulterior motive to the decision to invest sustainably? And second of all, if there's this impure altruism in the decision, is it intrinsic or is it extrinsic? And by that I mean, are you sending a signal to yourself that you're a good person, or do you want the world to know that you've done something good? And there's a bunch of experiments I ran. I picked just a couple here for today's talk. The first one, I tried to elicit preferences for sustainable investing somehow. And there's plenty of methodological things that can be done. I just asked them how much they're willing to give up in return or how much they're willing to pay in fee to be able to invest in a sustainable fund. So again, the question is traditional versus sustainable. If you pick sustainable, how much would you be willing to pay for that? in terms of percentage points, return percentage points. And now I wanted to measure warm glow, and there's a couple of standard ways of doing that. One of them is you ask the participant to donate to a charity of their choice. You give them money, say 100 sterling pounds here. You tell them you can keep all of it, or you can donate some, none, or all of it to a charity of your choice. And now the trick here is you tell them whatever you donate, even if it's 0, we, the university, are going to top it up to the maximum 100, so that the charity will always receive 100 regardless of how much you contribute to it. So if you're not giving anything, I'm giving them 100. If you're giving 10, I'm topping it up with 90 so that you've lost 10, but the charity is going to get 100. And the point here is you're taking out the impact factor. So the impact is constant now, and what you're giving up, you're just doing it for yourself. And I'm doing 2 treatments to address the private versus the public. So in one treatment, the choice is anonymous, and in the other, I'm going to publicly list all the names of the donating people on the website. And to look more into the warm glow combination with intrinsic versus extrinsic motivations, I ran another experiment using a pay-what-you-want pricing scheme. So I'm asking them, you have, again, traditional and sustainable fund, and now you can voluntarily contribute in terms of some kind of percentage fee to the sustainable fund. How much would you be willing to pay for that? And again, I have 2 treatments. One is anonymous and one is a public announcement of all the people that contributed. And now some standard statistical results. The first thing I did is I regress the donations to the willingness to pay, and I see a clear relationship. So I didn't even have to enter this here. It's a very, very simple standard linear regression. So there seems to be a fairly significant, even though n is quite small, 150, there seems to be some significant relationship between the two, not causal yet. And now if we're looking at the 2 treatments, to the left here you see the distribution of the amount people are willing to pay to invest in the sustainable fund in each treatment. And on the right-hand side, you see the average willingness to pay for the sustainable fund in each treatment. So what you see here, the average seems to be higher in the private treatment, and the variability seems to be higher as well. So things kind of tend to shrink towards a smaller value, and everybody's around that smaller value in the public treatment. Again, no causality yet. But I'm personally interested in causality because in practice I want to know if you were to implement the anonymity versus you want to show everybody, or you want to tell somebody that's coming to you and wants to invest, I'm going to give you a credit card that says green whatever for a green future, just to signal to everybody that you've invested sustainably, if this is going to make a difference or not. And to get causality, I'm applying something that's used in the medical literature quite a lot, where you try a drug on someone and you count how many people this has worked for. So to get this contingency table, I'm dividing up people in the private and public treatment according to how many paid less than average and how many paid more than average. And the average I got out of a second experiment that was a controlled experiment where neither of these treatments were explicitly said. The average was around 2.8% or something. And you see here that the willingness to pay, there's a lot more people. The majority is in the private treatment want to pay more than average. The majority in the public treatment want to pay less than average. And the Fisher causality test here is quite significant as well. And we see the same picture in the pay what you want. So again, I introduced this pay what you want scheme because mainly to see from another angle if this intrinsic versus extrinsic is going to hold in another setting. And I kind of see the same picture. There's a more willingness to pay on average in the private treatment, and more people pay more than average in the private treatment. And now the conclusion here is basically warm glow seems to play a role. It's a motivating factor. It's of course not the only one. And second, it seems like introducing this public treatment environment is mitigating the willingness to pay a little bit. And now what's the point of all this? What's the point of looking into behavioral foundations? To me, there are two angles to the story. I'm personally interested in the gap in the behavioral economics and decision theoretic literature and behavioral finance literature, where there's so many things that have yet to be understood. From a theoretical perspective, nobody knows what the utility looks like. Nobody knows how that relates to traditional utility. What are the equilibria of this utility when we take the entire population? What are the behavioral drivers? What are the behavioral barriers? A lot of these questions we now know for classical finance, behavioral finance, but not in the sustainable finance space. And the other thing is, of course, practical application. And I don't know how many practitioners are here today, but they would want to say, okay, then I'm going to go to my client now and tell them, invest sustainably, do good, rather than invest sustainably because the impact is amazing. I'm going to tell them, stay anonymous and so forth. And here I wanted to end on a note with, I would personally think it's unreasonable to already now start implementing some kind of nudging in the private sector. First of all, because of the three unknowns in the beginning. If nobody knows about impact, measurement, or performance, but then we want to push everybody to go in some direction, I would not think this is fair to people on the other end that have limited capacity for understanding. And the other thing, even if these three items were known, I would not take my very simple results today and go out and implement them. Field experiments, large-scale field experiments would be necessary to do that, which I still hope to do one day. And so I think with that, I'd like to thank you all.